I lost my entire fortune 3 times. That's right. I wiped out completely on 3 separate occasions during my trading career. Most people know me as the greatest trader who ever lived, the man who made 100 million shorting the 1929 crash. But what they don't know is how I discovered the power of moving averages after my most devastating loss. This revelation changed everything for me, and in the next few minutes I'll show you exactly how I use this principle to rebuild my fortune and how you can apply it to protect yours. The year was 1908. I had just lost my second fortune, over $1 million, equivalent to about $30 million today. I sat in my hotel room, staring at charts, wondering where I'd gone wrong. The market had humbled me again, as it always does to those who ignore its warnings. That night, I discovered something that would transform my trading forever. Looking at price charts spanning decades, I noticed that prices tend to move along invisible lines, what we now call moving averages. When prices deviated too far from these lines, they inevitably returned, like a pendulum seeking equilibrium. I developed a simple but powerful rule: never trade against the primary trend, as defined by these moving averages. When prices moved above the average line and stayed there, I bought. When they fell below and remained there, I sold or went short. This wasn't just theory, it was survival. In 1929, while others were still buying into the mania, my moving average system had already signaled danger. The market had detached too far from its long-term average, stretching like a rubber band that must eventually snap back. I began building my short positions methodically, not based on fear or headlines, but on this mathematical principle. When the crash came, I made $100 million because I respected what the moving averages told me, not what the newspapers or my emotions suggested. The market doesn't reward hope or punish fear. It simply reflects reality, often before that reality is obvious to most. Here's what I learned. Moving averages smooth out market noise and reveal the true direction. A 200-day moving average shows the primary trend. A 50-day shows the intermediate trend. When the 50-day crosses above the 200-day, it's often a signal of strength. When it crosses below, weakness may lie ahead. I don't predict market moves. I react to them. When prices respect these invisible lines, I respect the message they send. This single principle saved me after devastating losses and built my third and final fortune. In the coming minutes, I'll show you exactly how I implemented this system, the specific signals I looked for, and how you can apply these same principles to navigate today's markets, whether you're trading stocks, commodities, or cryptocurrencies. The markets have changed, but human nature and mathematics haven't. The 3 moving average framework that revolutionized my trading career wasn't something I developed overnight. It came after losing my fortune twice and rebuilding it from scratch. When you've been humbled by the market as I have, you develop an almost religious respect for trend identification. My framework uses 3 specific moving averages that work in concert: the 10-day, 50-day, and 200-day. Each serves a distinct purpose in my decision-making process. The 10-day moving average signals immediate momentum shifts. I watch this like a hawk for early warnings. The 50-day shows intermediate strength, while the 200-day reveals the primary trend, what I call the tide of the market. When these 3 lines align in a specific formation, I see opportunity where others see nothing. In 1907, during the banking panic, I watched these averages signal a major market reversal weeks before the newspapers caught on. While others panicked, I positioned myself accordingly and walked away with over $3 million, an astronomical sum for that time. The power lies in the relationship between these averages. When the 10-day crosses above the 50-day, I prepare for potential entry. But, and this is critical, I only commit significant capital when both remain above the 200-day line. This confirms the primary trend remains bullish. The reverse signals potential shorts. I've noticed most traders overcomplicate their analysis. They drown in indicators and second-guess themselves into paralysis. My framework strips away the noise. In the 1929 crash, these three lines warned me months before the collapse. The 10-day crossed below the 50-day, while both remained below the 200-day, a death cross formation that screamed danger. The beauty of this system lies in its simplicity and adaptability. It works across time frames and markets because it measures what truly matters, the direction and strength of money flow. Whether trading cotton in 1910 or wheat in 1925, these principles remained unchanged. I apply strict rules to this framework. First, never fight the 200-day trend. It's suicide. Second, confirm all signals with volume. Price movement without volume is meaningless. Third, be patient for alignment. Forcing trades between conflicting signals destroyed more accounts than I can count. This isn't merely technical analysis, it's understanding market psychology. These moving averages reflect the collective decisions of all market participants. By reading them correctly, I'm essentially reading the market's mind. That's how I turned $10,000 into $10 million during the 1907 panic, while others lost everything. Price action confirmation is where I separate myself from amateur traders. On a 15-minute chart, I look for three specific patterns that consistently signal high-probability trades. Let me walk you through my exact process. First, I identify what I call pivot rejection, when price tests a significant level and clearly rejects it. On 15-minute charts, I want to see at least 3 consecutive candles respecting this level. I don't just enter on the first touch. I wait for that third confirmation, which has saved me countless times from false breakouts. During the 1907 banking crisis, I watched as Union Pacific tested its support 3 times on the 15-minute chart before plunging. That third test gave me the confidence to short heavily. Second, I search for what I named volume divergence, when price makes a new high or low, but volume fails to confirm the move. On 15-minute charts, this divergence is particularly reliable if it occurs near a significant support or resistance level. I developed this technique during the wheat market collapse of 1925. While others were blindly following price, I noticed volume declining on each new low. A clear signal the selling pressure was exhausted. Third, I require momentum alignment across multiple time frames. Even when trading the 15-minute chart, I insist that the 1-hour and 4-hour trends align with my intended direction. I never fight the larger time frame. This principle alone would have saved me from my disastrous cotton trade in 1908, when I ignored the weekly downtrend while focusing on 15-minute reversals. I combine these 3 confirmations into what I call my triple verification method. When all 3 align, pivot rejection, volume divergence, and momentum alignment, I enter with size and conviction. This isn't theory. This is how I turned $10,000 into over $1 million during the 1907 crash. Critical to my approach is patience. Most traders overuse the 15-minute chart, jumping at every signal. I might watch for days before finding perfect alignment. During the Northern Pacific corner of 1901, I waited 3 full trading sessions before my triple confirmation appeared. While others panicked, I entered methodically and extracted maximum profit. Remember this, the 15-minute chart provides precision entry, not trade direction. Direction comes from larger time frames. Entry timing comes from the 15-minute confirmations. Master this distinction, and you'll avoid the trap that bankrupts most traders, confusing entry precision with directional analysis. Apply my triple verification method to your next trade. Wait for all 3 confirmations. You'll find your win rate increases dramatically while your anxiety decreases proportionally. Timing is everything in this game. I've spent decades perfecting my entry strategies, and what I'm about to share with you has made me millions on the 15-minute charts alone. The pullback strategy is my bread and butter. It's how I've consistently entered positions with minimal risk and maximum profit potential. When I look at a 15-minute chart, I'm searching for a very specific pattern, a strong trending move, followed by a controlled retracement. I don't chase breakouts. That's amateur hour. I wait for the market to come to me. The pullback gives me the perfect low-risk entry with a clearly defined stop loss. Here's exactly how I execute this. First, I identify the primary trend using the 15-minute chart. I need to see at least 3 higher highs and higher lows for an uptrend, or 3 lower highs and lower lows for a downtrend. Then I wait. Patience is your greatest weapon. The ideal pullback retraces between 38.2% and 61.8% of the previous move. I found this Fibonacci zone to be the sweet spot where weak hands get shaken out, but the trend remains intact. When price enters this zone, I don't buy immediately. I wait for confirmation. My confirmation signal is a candlestick pattern showing rejection of lower prices in an uptrend or higher prices in a downtrend. I particularly look for hammer patterns, engulfing candles, or simple rejection wicks. These tell me the pullback is likely complete. I place my entry order just above the high of my confirmation candle in an uptrend, or just below the low in a downtrend. My stop loss goes below the low of the pullback in an uptrend or above the high in a downtrend. This gives me a precise risk parameter. I learned the hard way in 1907 that position sizing is critical. I never risk more than 2% of my capital on these trades, no matter how confident I feel. The market doesn't reward overconfidence, it punishes it. For targets, I use the previous swing high or low as my first profit-taking level. I typically scale out of positions, taking 50% off at the first target and letting the remainder run with a trailing stop. The 15-minute time frame works beautifully for this strategy because it filters out the noise of lower time frames while still capturing intraday moves. I've used this same approach during the panic of 1907 and throughout the volatile 1920s. Remember this: the best trades feel uncomfortable when entering. If a pullback entry feels too easy or obvious, it's probably a trap. I've made my greatest profits when others were fearful of buying a dip in a strong uptrend or selling a rally in a downtrend. Master this pullback strategy on the 15-minute chart, and you'll have a powerful tool that works in any market environment, stocks, commodities, currencies, it doesn't matter. The market's nature never changes, and neither does the effectiveness of this approach. Now, I want to reveal one of my most powerful timing systems, a method I refined through decades of market warfare. I call it my triple moving average system, and it served me exceptionally well throughout my career. I developed this system after noticing that single moving averages produce too many false signals. The market, being the deceptive beast it is, loves to whipsaw traders out of positions with temporary price movements. I needed something more robust, something that filtered out the market's noise while capturing its true direction. My system uses 3 moving averages of different lengths: a short-term, 10-day, medium-term 20-day, and long-term 50-day moving average. The beauty lies in how they work together to confirm genuine market movements. Here's exactly how I implement it. When my short-term moving average crosses above both the medium and long-term averages, I consider it a strong buy signal. Conversely, when the short-term average crosses below both longer averages, I prepare to sell or go short. The key insight is that I require confirmation from all 3 time frames. This dramatically reduces false signals. What I'm particularly proud of is how this system kept me in the major trends of 1907 and 1929. While other traders were being whipsawed by market volatility, my triple screen filtered out the noise. I stayed with the primary trend and profited enormously. I don't just use this system mechanically, though. I combine it with volume analysis. When I see my moving averages align and volume expanding in the direction of the trend, I commit more capital. This combination has proven deadly effective. Let me give you a specific example. In 1907, as the market began its historic collapse, my short-term average crossed below the medium and long-term averages while volume surged. This wasn't just a technical signal. It was the market screaming at me to go short. I listened and made millions while others were devastated. The true power of this system is its versatility across different market environments. In choppy markets, it keeps me on the sidelines, a position that saved me countless times from unnecessary losses. In trending markets, it keeps me firmly positioned with the primary trend. Remember this: moving averages aren't magic. They're simply a tool to identify the direction and strength of the market's tide. What makes my system effective is the discipline to follow it religiously, even when my emotions scream otherwise. I've taught this system to only a handful of traders throughout my career. Those who implemented it with discipline have thanked me profusely. Those who abandoned it during difficult periods learned painful lessons about the importance of systematic trading. Timing is everything in this game. I've made and lost fortunes multiple times because of timing. Not just what to buy, but when to enter and exit positions. Let me share my method for timing the market precisely. I always wait for confirmation before entering a trade. The amateur rushes in at the first sign of movement. I wait until the market proves itself. When I see a stock breaking out of a consolidation pattern with increased volume, that's my signal. But even then, I don't go all in immediately. My scaling method has saved me countless times. I never enter a position with my full intended allocation. Instead, I start with a quarter or third of my planned position. If the stock moves as expected, I add more. This way, the market confirms my thesis before I commit fully. For example, in 1907, when I shorted Union Pacific, I didn't immediately take a massive position. I tested the water with a smaller short sale. When the stock dropped as expected, I added to my position. By the time the crash accelerated, I was fully committed and rode it all the way down. Exiting positions requires even more discipline. Most traders hold losers too long and sell winners too early. I do exactly the opposite. I cut losses quickly. They're just the cost of doing business. But with winners, I let them run until the market tells me the trend is exhausted. How do I know when to exit? I watch for pivotal points. If a stock that's been steadily rising suddenly fails to make a new high after a reaction, that's my warning sign. Similarly, if a declining stock fails to make a new low, the trend may be changing. I also pay close attention to volume. Diminishing volume on rallies in an uptrend often signals weakness. Conversely, declining volume on sell-offs in a downtrend might indicate the selling pressure is exhausting. Remember my cotton trade in 1923? I rode that bull market for months, adding to my position as prices climbed. But when prices stalled at a new high with declining volume, I didn't hesitate. I sold everything. 2 days later, the market collapsed. The key to my timing method is patience combined with decisive action. I can wait weeks or months for the right setup, but once I see it, I act immediately and with conviction. The market will tell you when it's time to enter and exit, if you're willing to listen. Most traders are too busy talking to hear what the market is saying. I made my millions by listening to the market, not to opinions or tips. Master timing, and you'll master trading. It's that simple and that difficult. Risk management is where most traders fail. When I developed my framework for 15-minute charts, I knew that controlling risk would be the foundation. Without proper risk management, even the best entry signals become worthless. For 15-minute charts specifically, I use a tiered approach to risk. I never risk more than 1% of my capital on any single trade taken from these shorter time frames. Why? Because the signal-to-noise ratio is lower on 15-minute charts compared to daily charts. I learned this lesson in 1907 when I was overtrading the short-term movements before the panic. My 15-minute chart risk framework has 3 core components. First, I determine my maximum dollar risk before I enter the trade. I calculate this by identifying my entry price and my stop-loss level. The difference, multiplied by my position size, equals my total risk. If this exceeds 1% of my capital, I reduce my position size accordingly, no exceptions. Second, I scale my position size based on chart quality. When I see a 15-minute setup that aligns with the daily trend, I'll take a full position within my risk parameters. But when the 15-minute signal conflicts with higher time frames, I cut my position size by half. This rule saved me countless times during the volatile markets of 1929. Third, I implement time-based stop losses on 15-minute charts. If a trade doesn't move in my favor within 3 15-minute candles, I exit regardless of price. Markets that don't move quickly in your favor after an entry on this time frame rarely perform well. I discovered this pattern during my cotton trades in 1919. For my trailing stops on 15-minute charts, I use the 21-period moving average. Once price closes above this average on a long trade, I move my stop to break even. After price moves 1.5 times my initial risk, I trail my stop behind each subsequent 15-minute close. This mechanical approach removes emotion from my exit decisions. Remember that 15-minute charts generate more signals, which means more opportunities to overtrade. I combat this by implementing mandatory rest periods. After 3 consecutive losses on this time frame, I step away from 15-minute charts for at least 2 trading days. This forces me to reassess market conditions from higher time frames. The beauty of this framework is its simplicity. I found that complex risk management systems fail under pressure. When markets move quickly, you need rules that can be applied without hesitation. My 15-minute risk framework has withstood the test of time because it acknowledges the inherent volatility of shorter time frames while providing clear guidelines for capital preservation. The market's language evolves, but its fundamental grammar remains unchanged. While I didn't have access to the sophisticated charting tools traders use today, I recognized patterns in price movements that modern moving averages now quantify precisely. Had these tools been available in my era, I would have incorporated them strategically, not as crystal balls, but as confirmation mechanisms for what price action was already telling me. I've always maintained that price tells the complete story. Moving averages simply help visualize that story more clearly. Today, I would use a triple moving average system: 10-day, 20-day, and 50-day exponential moving averages. When the 10-day crosses above the 20-day, while both remain above the 50-day, I'd recognize this as the market confirming a bullish trend. The reverse signals bearish momentum. However, I would never enter a position based solely on these crossovers. My approach would be to wait for a pullback to the 20-day moving average after a confirmed trend. This provides a lower risk entry point while maintaining the direction of the primary trend. Exactly the philosophy I pioneered in my trading career. The most powerful setup I would look for occurs when price tests but respects the 50-day moving average during an established uptrend. This often represents institutional support, the big money stepping in. I'd enter aggressively here with tight stops just below the 50-day line. For exit strategies, I'd watch for divergence between price action and the 10-day moving average. When a stock makes new highs, but the slope of the 10-day flattens, I'd begin scaling out. This typically precedes a more significant correction. One advanced pattern particularly worth noting is the moving average compression. When all three moving averages converge within a tight range after a period of trending, explosive moves often follow. I'd wait for the first decisive break from this compression zone, then position myself accordingly. Remember, these technical indicators merely quantify what I observed through pure price action. The underlying principle remains identical to what I practiced a century ago. The trend is your friend until it bends. Don't make the amateur mistake of using moving averages to predict market turns. I would use them to confirm what price is already telling me. They're a lagging indicator by design. Their true value lies in objectively defining the trend's direction and strength. My fortune wasn't built on predicting market moves, but on recognizing them as they unfolded. These moving average patterns simply provide mathematical confirmation of the market's intentions. The real edge comes from combining these technical signals with proper position sizing and ironclad discipline, principles that remain timeless regardless of the tools available. Let me share with you one of my most reliable strategies for timing perfect market entries, what I call my crossover strategy. I developed this approach after years of painful lessons, watching opportunities slip through my fingers because I entered too early or too late. When I look for the perfect entry, I'm watching for a specific crossover pattern between price action and market sentiment. I need to see price breaking through a significant resistance level while volume confirms the move. But here's the crucial part most traders miss. I wait for the emotional crossover. I learned this the hard way in 1907. I'd been shorting Union Pacific, watching it drop from 170 to 128, but I covered my position too early. Had I waited for my crossover signal, when public panic fully manifested in the trading volume, I could have ridden it all the way down to 100. That mistake taught me patience. My crossover strategy requires three elements to align: price, volume, and time. When price breaks through a significant level, I confirm it with increasing volume. But the timing element is what separates my approach from amateur tactics. I wait for what I call the third confirmation, usually a retest of the breakout level that holds. During the 1929 crash, I implemented this strategy perfectly. I spotted the initial break in September, watched volume patterns confirm the move, then waited for the third confirmation, a failed rally attempt, before committing my full position. This patience allowed me to profit over $100 million in today's dollars. Remember this: amateurs rush in at the first sign of movement. Average traders wait for the second confirmation, but I wait for the third. That's when the true trend establishes itself. I've found that perfect entries come when others are still uncertain. When I see price, volume, and time align, that's my signal. The market will often give you a brief window where the crowd hasn't fully recognized the opportunity. That's your moment. My crossover strategy isn't just about technical indicators. It's about recognizing when market psychology shifts. I look for that precise moment when the last holdouts capitulate, or when the final skeptics finally jump in. That psychological crossover is more powerful than any chart pattern. I've used this approach in every major market move of my career. Whether it was cotton in 1910, wheat in 1925, or stocks in 1929, the principle remained the same. Wait for the crossover of price, volume, and market psychology. Master this timing, and you'll find yourself entering positions precisely when the odds most favor your success. Let me share with you my exit framework for the 15-minute chart, something I developed after losing fortunes multiple times. The market gives, then takes away. I learned this lesson the hard way, watching millions evaporate because I didn't have disciplined exit rules. My 15-minute chart exit framework has 3 tiers, each designed to protect profits while allowing trends to develop fully. When I first traded Union Pacific in 1907, I left millions on the table by exiting too early. Later, during the 1929 crash, I held positions too long and watched profits vanish. These painful lessons shaped my framework. First tier, the 3-bar reversal exit. I watch for 3 consecutive 15-minute candles moving against my position after a strong trend. During the Northern Pacific corner of 1901, I noticed this pattern repeatedly signaled exhaustion before major reversals. When I see 3 red candles after a strong uptrend on the 15-minute time frame, I exit at least 1 toss or 3 of my position. No hesitation, no emotional attachment. Second tier, the moving average breach. I use a 21-period exponential moving average on the 15-minute chart. When price closes below this moving average after trading above it during an uptrend, I exit another third of my position. I discovered this signal during the 1907 banking panic. It kept me from giving back substantial profits as stocks collapsed. Third tier, the volume spike exit. Abnormal volume on the 15-minute chart often signals institutional participation and potential reversals. When I see volume 300% above the 20-period average, accompanied by price moving against my position, I exit my final third. I used this exact technique during the wheat corner of 1925, preserving most of my profits before the inevitable collapse. The beauty of this tiered approach is psychological. By scaling out in thirds, I satisfy both my desire to protect profits and to capture the full trend. The first exit secures some profit, relieving psychological pressure. The second exit locks in more gains if the reversal continues. The final exit allows me to ride the maximum trend while still having rules to preserve capital. I combine these exit signals with time-based rules. Any position showing no progress after 8 15-minute bars gets reduced by half. This time stop prevents dead money from sitting idle, a lesson I learned in 1908 when I sat watching stagnant positions while other opportunities passed me by. Remember, entering positions is only half the battle. My fortune was built not just on identifying trends, but on exiting them properly. The 15-minute chart framework gives structure to what most traders handle emotionally, and emotions are deadly in this business. Market volatility is where I've always made my greatest profits. While other traders run for cover, I see opportunity. My secret weapon? A precise combination of moving averages that act as my early warning system for major market moves. I've refined this technique through countless market cycles. I use a specific triple moving average system that cuts through market noise. First, I track the 10-day moving average for immediate price action. Then, I overlay a 30-day moving average to establish the intermediate trend. Finally, I add a 90-day moving average to confirm the primary market direction. When these three lines begin to converge after a period of separation, I prepare for action. The magic happens in the relationship between these averages. When the 10-day crosses above both the 30-day and 90-day after a market decline, I see this as a powerful buy signal. Conversely, when the 10-day drops below both longer averages after a market advance, I prepare to sell or establish short positions. I learned this lesson painfully in 1907 when I ignored my own signals. The market was showing classic divergence between my moving averages, but I hesitated. That hesitation cost me millions. I never made that mistake again. During the volatile 1920s, this system kept me on the right side of major swings. As the 10-day average began dropping sharply below my longer averages in September 1929, I established massive short positions. When the crash came, I was fully prepared. What makes this system particularly effective is how I adjust the sensitivity during different volatility regimes. In calm markets, I tighten the parameters, looking for 3% divergence between averages. During highly volatile periods, I expand to 7% divergence to avoid false signals. The key insight most traders miss is that these moving averages must be weighted by volume. Price movement alone can be deceptive. By incorporating volume, I get a clearer picture of the market's true direction and conviction. I found that exponential moving averages work better than simple ones in capturing momentum shifts. The extra weight given to recent price action helps me stay ahead of major moves rather than constantly reacting to them. Remember, these moving averages aren't just lines on a chart. They represent the psychological state of all market participants. When they converge and diverge in specific patterns, they're telling you exactly what the market intends to do next. I don't use these signals in isolation. I combine them with my rules on market confirmation and sector rotation. But this moving average combination has been the backbone of my volatility trading strategy. The same strategy that allowed me to profit in both bull and bear markets when others were being wiped out. I've always believed that any strategy worth trading must be worth testing. When I developed my moving average strategies in the early 1900s, I didn't have computers. I had notebooks, pencils, and determination. I'd spend hours manually plotting price movements and testing my theories against historical data. Today, you have tools I could only dream of, but the principles of my backtesting framework remain unchanged. Let me share how I validate any moving average strategy before risking a single dollar. First, I select a robust testing period. I never test just during bull markets or just during bears. That's a recipe for disaster. I insist on testing across full market cycles, including at least one major correction and one strong uptrend. When I was trading cotton futures in 1907, I tested my crossover strategies against the previous decade's data, which included both the panic of 1901 and the boom of 1904. Second, I measure more than just raw returns. Anyone can create a system that looks profitable on paper. I analyze drawdowns religiously. The maximum percentage my account would have dropped during the testing period. My rule: if I can't stomach the historical drawdowns, I won't trade the system live. When my 10-30-day moving average system showed a 22% drawdown during backtesting before the 1929 crash, I knew exactly what I was signing up for emotionally. Third, I compare performance against simple alternatives. I always ask, does my complex system actually outperform a basic buy and hold approach or a simple 200-day moving average system? If not, why add the complexity? I abandoned countless strategies that couldn't beat these benchmarks. Remember when I made $3 million shorting the 1907 market? That strategy had proven itself superior to alternatives in my backtests across 3 previous panics. Fourth, I test for robustness by slightly varying parameters. If changing a 20-day moving average to a 22-day moving average completely breaks your system, you've built your strategy on quicksand. My best systems work across a range of parameters. My wheat trading system from 1925 performed consistently, whether I used 18, 20, or 22-day averages. That's how I knew it captured a real market inefficiency. Finally, I paper trade before going live. Even after rigorous backtesting, I always traded a new system with imaginary money first. This final step saved me countless times from strategies that looked perfect on paper but failed in real market conditions. Remember, backtesting isn't about finding a perfect system. It's about understanding the limitations of your approach before the market teaches you those limitations with real money. What will your legacy be? I've spent decades in the markets, made and lost fortunes multiple times, and I've come to understand that a trader's true legacy isn't measured in dollars alone. My name will forever be associated with the greatest short trades in history. But what matters more is what I've learned along this journey. The market has been my greatest teacher, and now I'm passing these lessons to you. Take action on what I've shared today. The principles I've outlined aren't theoretical concepts to be admired from afar. They're battle-tested strategies that require implementation. I remember sitting at my trading desk after losing everything for the second time. The pain was excruciating, but that moment of reckoning forced me to codify the rules I'd been breaking. Those same rules eventually rebuilt my fortune. Your legacy begins with disciplined execution. Start small. I didn't begin by shorting the entire market in 1929. I built my approach methodically, testing my theories with limited capital until my conviction warranted larger positions. Your first step is simply to implement one principle from today's discussion, perhaps my pivot point analysis or my rule on cutting losses immediately. Document everything. My trading journals saved me from repeating the same mistakes. Create your own system for recording trades, emotions, and market observations. This record becomes invaluable when patterns emerge over time. I could trace my greatest successes back to insights gleaned from previous failures documented in these journals. Find your edge. Mine was identifying major market turns and riding trends with unwavering conviction. Yours might be different. Perhaps you excel at sector rotation, value investing, or technical analysis. Discover what resonates with your temperament and double down on developing that specific advantage. Remember that longevity is the ultimate achievement. I survived multiple market cycles, crashes, and personal financial disasters. Each time, I returned stronger because I adapted while maintaining core principles. Your trading career should be measured in decades, not days. I've given you my playbook, the exact methods I used to anticipate the crash of 1929 and other major market moves. Now it's your turn to apply these lessons and create your own legacy in the markets. The principles remain unchanged. Cut losses, let profits run, trade with the trend, and maintain iron discipline. The market will test you relentlessly, just as it tested me. But armed with these strategies, you now possess the framework to withstand its challenges. Your Livermore legacy begins today with your very next trade. Make it count.